Hi, T.S. Hennessy here. Welcome. There's a brand new, previously unknown window into Forex that I'm going to uncover to you. This is also a story of an accidental discovery. You're about to have your eyebrows raised like when something catches you off guard. Oh yeah, even if you're a jaded old trader like me, and you've seen all the indicators, and you instantly see right through red light, green light systems and other junk out there, well, it was something that completely startled me. If it was already known, it would have been on my radar, so I would have thought. But it's very sneaky how it went undetected, and now that I do know it, I'm actually a little embarrassed that it remained hidden from me. So it's called base tuning. The result is obvious, plain as day, what it means for you. Let's look this over.
Ladies and gentlemen, may I have your attention, please?
Base tuning is adjusting your technical tools for the specific currency, actually the base currency of the pair. You surely know euro-dollar's base is euro. And here's the discovery. The sneaky market's huge secret is that each base currency runs at its own unique Fibonacci ratio. They're not all the same, but of course this definition is something previously unknown and hidden, so it needs to be demonstrated. Okay, we have the Euro-Yen M5 here with two moving averages on it, and I started with a period setting that I liked, and then I modified both of these times 1.6 on that period setting. That just changes it from M5 view to M8 view, but while this one stopped there, this one has also been modified by the time frame as well as the euro base pair. Okay, now here we have the base tune dynamic support and resistance set to a weekly time frame on the Aussie dollar. Now in a similar way as you saw on the M5 chart set with M8 indicator setting, this is a weekly chart, but it still catches it very, very well. This is a Fibonacci number, 317,811. The market is so good at math, it keeps track of these type of numbers on a weekly time frame. Now that comes with the set, all you got to do is load it up. But this particular spot is such a big number that it only shows the fastest of the indicators. Let me show you the full set, because we're going to see a confluence of indicators coming in right at that reversal right there. Now you can see the full complement here on this tool. I've loaded up the same chart, and it's ratio 2.000, which is of course another Fibonacci number. And there's the confluence. We had a bounce off of that, but as you can see, it was already using this particular thing, and then it goes on further when it bounces again off of that same thing that it bounced here. Now there's some more confluence of indicators. Before you saw on the other chart on the 2 ratio that we bounced off of the white dashed line after coming off of there with some confluence on those two, and then it had bounced there. Here's a 764 ratio on the same chart, weekly Aussie dollar, and it's been using it in the past up in here, and it's using it again here. So this is what it does. And here we have a franc yen H4 on ratio 1.618. All you need to do is load these up. The tool does all the work. It does the adjusting for the time frame. It does the adjusting for the pair. As you see here, this says that it's base tuned for all franc pairs. All you have to do is load any chart, and it's going to take care of all the business. And this is just going to show you that the franc yen has been paying attention to 1.618 ratio with these particular indicators all over the place, really. And so I think it's really just a matter of you understanding that this isn't going to give you a signal, but rather it's just something that the market can show you what it is paying attention to, and then you can have a better idea where reversals should be planned for. This means that these tools have the rare property of being a leading indicator. Whatever style of trading you're doing, whether it be scalping or long-term swing trading, whatever your risk appetite, do you want to plan a trade? How about a second opinion? And how about checking in with the market? Here we are back again on the Aussie dollar, this time the daily, and we've chosen 3.618 ratio. Actually, you can see that there was really more confluence. This indicator on the daily is also showing that that should have been a place to plan for a reversal. Okay, so it's decision support, and that's what it's all about. Now, we're back on the Aussie dollar on a different chart. This is the daily again, but this is a Fibonacci number 1597. Yeah, it may not be a fib number that you're familiar with, but the market is, and there again we had confluence on that reversal right there. There's also indications that the market has been using this Fibonacci undercurrent for everything that it's been doing, and the market is obviously very good at math. Okay, we saw the franc yen H4 1.618 earlier. I just wanted to zoom in here because I'm not that good at math. Are you? But the market is really, really good at math, and you can see that it's keeping track of Fibonacci. So here's something that we want to look at in addition to the way the market uses Fibonacci. We want to look at the way the market has repeating patterns. Here on the daily, we've seen this bounce off of a descending line and set a new trend low, lower than here. So I want to show you how the market repeats. Take a look at this right down here, and we'll look at this on a smaller time frame. Okay, so I've changed this now to a 1 hour. It's on a ratio of 5, and that's of course a Fibonacci number. And we've got this descending line, nice. This is that same down move, and the smaller ending to it, and it sets that new trend low right after that descending line. And this is the end of the line for this, and then it moves up. And I want you to notice what happens that's different is that once that magenta line has flattened out, the market is in for a consolidated area. So you're going to have some chop in there, and you can expect and exploit it however you please. And how would you know that that's the end of the line down here? Well, of course, we want to use common sense with the larger time frames, understanding where the market's coming and going from and to. So remember, this is the miniature view where we're setting a new low off of another one that is also coming off the same pattern. There's a good shot that we should be aware that such a long move would come to an end someplace, and so we want to look out in our leading indicator for where that might happen. So we peruse the landscape on the larger time frames, and of course all you do is load these up. I've loaded a monthly chart with the 1.0 ratio, finding after a large weekly move and having lots of confluence for that down move, then getting some good indication that that was coming to a close, we have an ascending line. Okay, so that's good for a bounce and should be planned on. So do you think that the banks are manipulating the market? Well, I don't give them that much credit for this kind of precision. But let's say that, now I'm not talking about the brokers moving prices where other brokers don't agree, but that's different. But market manipulation is a big subject. What makes the market go, where it goes, and so on. It's all debated at length in the forums and everything, but let's just say that even though I don't give the banks that much credit, that I'm wrong. And they know about this very thing that I'm showing you. I've never heard anything about each base pair running at its own unique Fibonacci ratio. I've never seen this kind of precision, especially in a leading indicator. If the banks are moving the market around, certainly they have that power when they're placing orders, but do they know about this? I don't know. However, regardless of whether that's true or not, shouldn't you know about it and plan your trades? Well, of course you should. I think a lot of times traders, for lack of confidence, talk themselves out of very good trades. If you have the market to do your consulting with, how would you go about that? I think you use a characteristic of the market that's true of all support and resistance, and this is dynamic support and resistance, but it's still going to follow the one concept that what the market did before will do again. Yes, the market does have a memory. If it shows interest by reversals in one spot, it will remember that later on. Let's take a look at some of these.